Imagine this. You're scrolling on your phone when you hear someone say, I bought some Apple stock, or the stock market crashed today, or maybe investing made me thousands of dollars. And you're sitting there wondering, what even is the stock market? Is it gambling? Is it only for rich people? How do stocks become worth money? And how do regular people actually earn money from investing? Today, we're breaking down everything you need to know about the stock market in a simple way. By the end of this video, you'll understand what stocks are, how the market works, how investors make money, and some beginner tips just because that could save you from expensive mistakes. So let's begin. So what even is the stock market? Think about your favorite company. Maybe it's Apple, maybe it's Nike, maybe it's Spotify. These companies need money to grow. They need money to hire employees, create products, build factories, and expand around the world. One way they can raise money is by selling tiny pieces of ownership in the company. These tiny ownership pieces are called stocks or shares. If you buy one share of a company, you own a very small part of that business. You won't suddenly become the CEO, but you do become a part owner. The stock market is simply a place where people buy and sell those ownership pieces. That's it. The stock market isn't a physical building anymore. It's a giant network where millions of people trade shares every day. So let's say you buy a share of a company for $100. Over time, the company grows, more people buy its products, its profits increase. Because investors believe the company is becoming more valuable, they are willing to pay more for its shares. Now, your share might be worth $150. If you sell it, you've made a profit of $50. This is called a capital gain. Many investors buy stocks because they hope the value of the company will grow over time. So this is where things get interesting. Stock prices move based on one thing: supply and demand. If lots of people want to buy a stock, the price rises. If lots of people want to sell it, the price falls. But what makes people want to buy or sell? Well, things like company profits, new products, economic news, interest rate, competition, public opinion, world events. For example, if a company reports record profits, investors might become excited. More buyers enter the market, the stock price rises. But if the company loses money or faces problems, investors may sell. The price falls. So how do investors actually make money? Well, there are two main ways. The first one is capital gains. This is the most common. Buy low, sell higher. For example, you buy a stock for $100. You sell it for $150. You make a profit of $50. So this is very simple in theory, but it is harder in practice. Secondly, we have dividends. Some companies share part of their profits with investors. These payments are called dividends. Imagine owning shares in a company that pays dividends payments every year. Even if you don't sell your shares, you may receive cash payments just for owning them. It's similar to collecting rent from an apartment, except you're collecting income from your investment. Not all companies pay dividends, but many large and mature companies do. So you may hear terms like S&P 500, Nasdaq, Dow Jones. These are called stock market indexes. Think of them as scoreboards. Instead of tracking one company, they track groups of companies. For example, the S&P 500 tracks roughly 500 large American companies. So when people say the market went up today, they're often referring to an index. Indexes help investors see how the overall market is performing. So the secret most beginners don't know. Many people think investing is about finding the next company that will explode in value. But research shows that most professional investors struggle to consistently beat the market. Even experts often get it wrong. That's why many successful investors simply buy index funds. An index fund is a basket containing many companies. So instead of buying one company, you buy hundreds at once. This spreads risk. If one company struggles, the others can help balance things out. This is called diversification. And diversification is one of the most important concepts in investing. So every investment carries risk. A stock can rise, but it can also fall. Imagine investing $1,000. The next month it becomes $900, then $800, but then $1,100. Price fluctuations are normal, and this is called volatility. The stock market rewards patience, and historically markets have experienced crashes, recessions, and major downturns. But over long periods, broad stock markets have generally trended upward. Though this doesn't guarantee future returns, but it helps explain why many investors focus on years rather than days. So here are the biggest beginner mistakes. Well, the mistakes that trap many new investors. Firstly, investing money you'll need soon. If you need the money next month, for example, for rent, investing it may be risky because markets can fall unexpectedly. Okay? The second mistake is following hype. Just because everyone online is talking about a stock doesn't mean it's a good investment. Many people buy at the peak of excitement, then panic when prices drop. It's a little bit when things are trendy. I think in my last video I talked about this Stanley Cups, and I think they're only that popular because it's trendy, not because oh my days they look so good, and gosh, I think I have this crush on the Stanley Cup, and wow, its functions are so great. I don't think it's because of that, it's just because it's trendy. Doesn't mean it has to be the best, and same with stocks. Then we have mistake number 3, panic selling. Markets go down sometimes, and that's normal. Many beginners sell during crashes and lock in losses. And this is something you should totally avoid. I think I did this at the very beginning. Probably my biggest mistake, and which resulted in me not having the biggest beef steak. If you get the reference. Then mistake number 4, trying to get rich overnight. The stock market is generally a wealth building tool. often succeed are the ones who stay consistent for years. So don't get fooled by the people online, okay? Like, nothing online is true, okay? I may yap a lot about like, yeah, I'm a billionaire, I own 7 businesses, and I'm the best investors of all time, and that is why you should listen to this video. Sure, it's very hooking and people will probably watch your video, but at the end of the day that is not true, and keep that in mind because, well, you only see you just see the winners who win the lottery ticket, but you will never see those who lose. That's very rare. But I can assure you it's like 99% of the population that buys a lottery ticket that actually lose. Same with investing. No one gets like $1 million just like that. It's consistency that will actually make you become richer and richer for each year. Okay, remember that. Which leads us to the power of compound growth. So let's talk about something that feels almost magical: compounding. I believe I mentioned this a lot in my videos, but it is so important in every aspect of your life. So imagine investing $100. You earn 10%. Now you have $110. Next year you earn 10% again, but you're no longer earning returns on $100. You're earning returns on $110. Over time, growth starts building on previous growth. The longer money stays invested, the more powerful compounding becomes. This is one reason people often start investing early. Time becomes one of their greatest advantages. And if you can't really invest because you're under 18, ask your parents, don't be afraid. So if I were starting today and I was a complete beginner, I would focus on learning before investing. Maybe find an app that teaches you how to invest. That is like not with real money. Understanding risk, investing consistently, avoiding hype and emotional decisions, thinking long term, diversifying investments, and be patient. And do you notice what is missing? There are no secret formulas, no guaranteed shortcuts, and no magic stock picks. Most successful investing comes from simple habits repeated over long periods. So don't believe all these YouTubers and TikTokers that's like, yeah, buy this stock and you get rich overnight, or yeah, invest when okay, I'm not that into investing, maybe I'm just brainwashed, or I wouldn't say brainwashed, maybe I'm just not as educated as those people, but I truly believe that they mostly tell you that to get as many viewers and followers, and if you want to do that, go on, but truly it's just about being consistent and keep in mind which stocks you are picking and how much risk you are willing to take. Okay? So the real question, is the stock market gambling? This question comes up a lot, and the answer depends on how it's used. If someone randomly buys stocks based on rumors, excitement, or social media trends, it can start looking very similar to gambling. But if someone researches companies, diversifies, invests consistently, and thinks long term, investing becomes something very different. The goal isn't luck. The goal is ownership and long-term growth. So the stock market can seem intimidating. There are charts, numbers, financial terms, and endless opinions online. But at its core, the idea is surprisingly simple. Companies need money. Investors provide that money. In return, investors receive ownership. If those companies grow over time, investors may benefit through rising share prices and dividends. But the most important lessons: don't Don't focus on getting rich quickly. Focus on learning, focus on patience, focus on making smart decisions over many years. Because in investing, time often matters more than talent. So, thank you so much for listening to this video and watching this YouTube video. I hope you enjoyed this explanation, and subscribe for more videos where I will make economics, finance, and math related videos. So if you have any questions about any topic in those areas, just write that in the comment and I'll do a video about it in the future. I hope you cannot hear the motorcycle outside my window. I'm sorry if you did. But thank you so much. I'll see you in the next one. Bye bye.